Hello and welcome to the Solutions Scoop. I'm Ravi Venkatraman.
And I'm Amanda Tepper. Ravi and I are co-founders of the Chestnut Solutions Institute, an independent forum dedicated to advancing the future of the investment solutions industry. Here at The Scoop, we examine the latest solutions marketplace developments and speak directly with solutions industry leaders. Our guests span the investment ecosystem, from OCIOs to asset owners, investment consultants, asset managers, and other key industry stakeholders.
These conversations are an important part of the Institute's mission to improve transparency and help establish standards and best practices across the solutions industry by educating asset owners, providers, and all other industry stakeholders. Let's get to today's scoop.
Good morning, everyone. My name is Michelle Brown, and I'm Executive Director of the Chestnut Solutions Institute. I'm so pleased to welcome you to this webinar discussion today focused on alternatives in investment solutions. We all know that the alternative space is both multifaceted and complex. And so today we've gathered a panel of experts to speak about the alternatives marketplace overall in the context of providing investment solutions. And given the expertise on this panel, there's an opportunity to really dig deeper into some of the most important segments of alternatives today, like private credit, private equity, real assets, and venture capital. So let me take a moment to introduce our three panelists very briefly. Brandon Dees is the head of alternative investment solutions at Morgan Stanley. Kenny Pitman is a principal and alternative investments director at Mercer. Jake Pflaum is a partner on the private investments team at American Century. And finally, our moderator, Eva Xu, is an advisor to CSI and has spent over a decade in the alternatives investment marketplace. So with that very brief introduction, Eva, I'm going to turn the conversation over to you.
Thank you, Michelle. Good morning, everyone, and welcome. So today, I'm very excited to have an opportunity to moderate this conversation. We're going to cover the following subjects. First, we will define alternative asset classes in terms of the global investable universe. Second, we'll discuss how to include these asset classes into your portfolio construction process in the strategic asset allocation. And then finally, we'll cover some implementation issues such as manager selection, fees, and vehicles. So with that, we are going to start our conversation today. And what you see here is the global investable market. Obviously, the two big largest pieces are global equity and global funds, global bonds. Global equity is $81 trillion and 34% of the total AUM, with bonds $160 trillion and 58%. The remainder, representing about $19 trillion or 8% of total AUM, is the alternative universe. If we think about what has been happening in the last couple of years, we've been witnessing very rapid growth in alternatives. This is both in terms of improved accessibility and available solutions, as well as allocations into the alternative asset class. In fact, Pitman forecasts in the next 5 years, that is between 2023 to 2028, this piece of 8% will be growing at 8% per year. So to get to about 25 trillion by 2028. If we zoom into the 8%, breaking it down to the underlying alternative asset classes, you will see some of the usual suspects in alternatives. The largest pieces being private equity, 28%, hedge funds, 25%, venture capital, 13%, and then with private credit and private real estate, both fast growing at about 9% each. And then there are other real assets to kind of round up the total pie. So while this 8% CAGR represents a very exciting opportunity to alternatives, let's first talk about exactly what sort of asset classes you would recommend to your clients in your solution business and why. So I'm going to start with Jake from American Century, who is our venture capital expert on the panel. So Jake, could you please discuss the largest piece by AUM, which is private equity? While you're at it, please address what is it and what differentiates private equity from venture cap. Thank you.
Yeah, absolutely. It's a pleasure to be here with everyone today. Thank you for your time. So yes, private equity is the largest component of the alternative asset class. And typically in private equity, what you'll see is the private equity groups, investors, identifying mature companies that they believe are underperforming for some reason. There could be operational efficiency, it could be the way they're levered, they could be whatever the reason for their struggles are. And the private equity investor comes in with a thesis to improve and tap into potential upside in the company to drive profitability, to drive multiple expansion on an exit, to get the company in a healthier position. They tend to take majority stakes in these companies, can be 100% ownership of the company, take it over completely. And it's often paired with some amount of leverage. I'm highlighting those aspects to then compare and contrast to venture capital, which is a little bit different. And then on the sort of like the risk reward equation for private equity, because you're buying into an established company with real assets typically and products already in the market, the downside compared to venture capital tends to be more limited because there is an ability to sell that company going forward. On the other hand, compared to venture capital, the upside is historically not as great. So you get a lower risk, lower return profile in private equity traditionally compared to venture capital. Now, in venture capital, these are very early stage investments. You're investing in new ideas. Often we're investing in pre-revenue and certainly pre-profitable companies. We are taking minority stakes, generally speaking, into these companies. And the hold period can often be longer than what you see in private equity because we're coming in so early in the maturation process of the company. So you might see hold periods of 5 to 10 years in a venture capital investment, whereas in private equity, typically you'll see sort of a shorter time horizon to get the turnaround that the private equity investor is going for.
Okay, thank you. And next, let's turn to private credit, which has been extremely popular in the last couple of years, and judging by the growth of AUM. Kenny from Mercer, could you please briefly describe the asset class of private credit and talk about what is it that makes this asset class so appealing, especially in the current interest rate environment? And then how about hedge funds? And has the interest been dropping off over at hedge funds?
Of course. Thanks, Eva. Thanks for having me. Private credit is a wide-ranging, diverse opportunity set. Ultimately, private credit means a privately intermediated transaction where one lender is providing credit to a borrower. And, that can mean a number of things. Following the great financial crisis, private credit historically has really meant direct lending. As banks delevered and exited the lending market for smaller companies, those companies are still a viable part of our economy. They needed credit. Private lenders have stepped in. And that market has really kind of matured and materialized over the past 10, 12 years into a very viable opportunity relative to high yield and floating rate bank loans. It is credit, it is spread oriented credit, right? It's similar to a lower grade fixed income instrument. Generally, the draw has been you get an additional premium for private credit, and you also get a floating rate exposure, which removes some duration from your portfolio. But what's been really interesting to watch over the past couple of years is the private credit market has grown and diversified. So the same way banks have exited lending toward smaller companies, We are now seeing them exit other areas of the market too. We've heard about the regional bank issues and how that might impact the real estate market. There are also areas such as trade financing and asset-backed credit that are offering significant opportunities that are liquidity challenged because they had been serviced by the banks and they're no longer. And we expect a lot of the big, strong lenders to kind of move into those spaces too. And we're seeing some wonderful opportunities. What's really interesting about your hedge fund comment, Eva, is that, a lot of the private credit universe historically has also been serviced by hedge funds. Hedge funds are willing to step in and provide liquidity when it's needed, and they've done that through time. So we're seeing this kind of meshing of opportunity set where both hedge fund managers and historically private equity firms are kind of really dumping into the private credit market space. And they're trying to build strategies and build allocations for investors. And it's really interesting to watch kind of the differing opportunity sets in the direct lending space. It's generally kind of a long only allocation that you're trying to get a yield. It's really cash flow oriented. Things like special situations where the hedge funds play are, again, totally kind of capital appreciation oriented. So it's really important when you're building portfolios to understand what you own, why you own it, how you own it. We're spending a lot of time at Mercer looking at portfolio construction on private credit because we do think the opportunity set's more than direct lending. It's more than just asset-backed credit, which is kind of the next wave we're expecting to see. There are a ton of different little pieces here. And we think they can add value to client portfolios.
Thank you. I've been thinking about these asset classes and thinking about the interaction between that and the interest rate environment. For example, do you worry about if, the migration is from bank lending to direct lending? Is it true that then transparency is somewhat reduced? And when you have a rapid increase of interest rate, there could be some credit event hiding out there somewhere? Or do you think that's perhaps is sporadic cases, but not a general trend and nothing to worry about in terms of aggregate credit risk?
I think it's generally something to think about and something to be concerned with. I'm not sure the newspaper headlines are kind of founded right now. A lot of those are based upon high level arguments as opposed to the detail. So ultimately, private lenders, most of those people that are in those shops came from the banks, right? Like it's not like this is a new thing to them. They've been doing this for years and years and years. Market structure has certainly changed it, and there's risk embedded in that. And there is also some risk embedded in the heavy interest we've seen in the asset class. As capital flows into specifically the direct lending marketplace, you do have to worry about that becoming a bit more commoditized, people chasing deals and maybe getting a little bit over their skis from a risk perspective. But, at a base level, we think a lot of the underlying credit exposures are similar between bank loans and between private credit. You do have to think about what manager you're allocating to, because private credit is, again, very diverse. When you talk about direct lending, you could talk about senior loans to companies that are spitting off a ton of cash. You could also be talking about offering, some type of mezzanine loan to a small family-owned business where most of the return is coming back in a PIK or a payment in kind that's not actual cash flow. So, again, there are different pieces to this market. There will be different elements of credit risk driven by where and how you're allocating. We are in a relatively sensitive economic time right now where it does look like things odds on are gonna come to a soft landing, but one or two things could knock us way off our horse as well. So you have to be very careful. Credit is always a concern in a credit portfolio, but I don't think that dynamic has changed all that much between like high yield and private credit. Transparency's changed, but ultimately transparency to me, I'm not the lender. How much transparency I get is not gonna impact the success or failure of that loan. Private lenders do still have a ton of transparency into their portfolio companies. And there is an argument to be made that people are probably coming to private lenders because they need capital. They can't get capital elsewhere. But you could argue that they're getting more transparency and they're going to get more kind of covenants and coverage. Covenants are also an interesting piece. Like covenants basically give you the ability to get ahead of a bad loan. They don't necessarily like fix a bad loan or stop a bad loan. So this reliance on transparency and governance, in our view, can be a bit unfounded. It generally makes people more comfortable, but it doesn't necessarily impact the success or failure of the investment.
Great. Okay, so let's now turn to Brandon Dees from Morgan Stanley. Brandon, could you please discuss private real estate and other real assets and what these other assets classes bring to the table versus what we've already discussed?
Thanks, Eva, and appreciate you and Michelle including me on the panel today. So in terms of real estate and real assets, the main subcategories of real assets, as you already mentioned, real estate, but also infrastructure and natural resources. And as a broad asset class, this can span equity and debt. And in terms of implementation, you can do this through primary funds, secondaries, and co-investments. So in general, real assets offers investors enhanced portfolio diversification. These are hard assets or tangible asset-backed investments. They're generally very, very low or negatively correlated to public equities and fixed income. They can provide better inflation protection than interest rate sensitive public market investments. And this is really due to the investments typically being longer dated in nature with contractual income that's either inflation linked or that have natural kind of income increases over time. So as an example, like rental housing within the private real estate market has an average 1-year kind of contract duration, and that typically resets to market rates each year. And so that would naturally increase if inflation was increasing in terms of pricing power. Real asset strategies also span the risk spectrum. So at the lower end, you've got core and core plus strategies. These are generally targeting attractive, consistent income with modest capital appreciation. And then at the other end of the spectrum, which is higher risk, higher return, would be more value add and opportunistic strategies. And those are generally more total return or higher return focused and generally would not provide an income component. If it did, it would be, a smaller portion of the return. So when you think about portfolio construction, real assets allows you to enhance overall income as well as total return, and you can be flexible in terms of which area of the spectrum you want to lean in or lean out of, given just general market dynamics. The other thing I would mention about real assets versus some of the other asset classes mentioned, it tends to be an area that's more tax advantaged for taxable investors. There's multiple layers of attractive tax incentives. That could be no corporate taxes on qualified REITs, pass-through tax deductions, no tax on distributions that are considered return of capital. So that's something to take into consideration for taxable investors. And then lastly, just in terms of views and opportunities. So within private real estate, generally, within Morgan Stanley's OCIO and family office, we've been pretty cautious on this space over the last 2 years. No real new dollars in, just given concerns around widening cap rates, increased cost of financing, and what we expected to be kind of impact of investor redemptions and forced selling. We have been a bit more constructive on areas like value add and opportunistic or distressed real estate over the past year. We think that GPs that have dry powder are going to be able to deploy that into a pretty attractive entry points on good assets that will be forced sold via investor redemptions or mounting pressure from what is a very significant wall of commercial real estate debt maturities that are coming due over the next few years. And so we think there's going to be stress within the sector, and it's going to be a multi-year opportunity for investors to take advantage. We also, I think Kenny touched on this, just issues in terms of the regional banking space last year and those banks really kind of stepping back from lending. And so for funds that are real estate debt funds, that has been, accretive in terms of pricing and negotiating power. So we like some of those funds as well. Infrastructure is an area that we favored. It tends to be more resilient and can withstand pressures of higher than average inflation and higher than longer for interest rates. It is an area that's evolved with secular trends over time. So we kind of call it the 3Ds: deglobalization, digitalization, and decarbonization. And these long-term trends have really driven a focus towards regional projects. It's increased demand for digital infrastructure, and it's amplified the focus and investment in renewable energy. So those are areas that we think are attractive on a long-term basis. And then lastly, from an implementation standpoint, we have like secondaries. I think generally that's kind of been consensus over the last year and a half or 2 years, just given the pricing dynamics. There's been some pretty deep discounts within the secondary market. That has narrowed a bit. We've seen the data over the past couple quarters, so that the discounts generally in that market have closed a little bit. I would say one exception is real estate, where there's still some questions on, what NAV really should be for some of these funds. The other thing I would say for secondaries is the benefits the secondaries offer tend to be even more amplified for things like infrastructure, just due to the longer duration nature of those investments. So we like it for that area as well.
Great. Well, I've learned a lot about real assets in the last 5 minutes. Jake, I'm going to go back to you to address where PE and VC are in their investment cycle relative to the interest rate cycle. What do you see in terms of exit opportunity, refinancing cost, etc.? Is there any risk lurking around tactically at this point?
Yeah, I would say there's opportunity lurking around. It's been frankly a challenging handful of years for VC and PE. I mean, if you look at sort of recent vintages, distributions have been slim from these asset classes for a variety of reasons in terms of coming to go public, M&A activity. For a variety of reasons, it's been a more challenging few years. That has changed dynamics, and I would say it's a quite investor favorable set of dynamics. And certainly I'll speak more to the VC side where I'm focused on in terms of what we're seeing in valuations on new deals, in terms of what investors are able to sort of gain and ask for in protections and, and the like in the sort of the deal making. And so what I am seeing is that investors that have dry powder have a really good opportunity sort of, now in the next couple of years to get excellent valuations. And, you're seeing companies, if you're a venture company that might have been raising a Series C now, they're doing them at Series A and Series B pricings from 5 years ago. And so you're seeing a pretty remarkable opportunity, in my opinion. Now, it's always difficult to be a little contrarian in that way because it has been a difficult asset class. It can be hard to allocate to that space, but there's opportunity currently. My belief is opportunity in private equity and venture capital. And it just, it speaks to, we've talked about diversification already. The same thing applies to venture capital and private equity. You need diversification of vintages. You should have a program in which you're investing regularly across the years because there's going to be stronger years, there's going to be weaker years. And then you can flex somewhat in terms of if you see additional opportunities, such as what I perceive to be the opportunity to be now in those spaces.
Great. Thank you for all your perspectives. Let's move on to now, talk about how do we include these into our portfolio construction. So mostly I heard diversification, right? But also I think research has shown, we know there's illiquidity premium in these asset classes. So we should, seriously discuss how one should thoughtfully include these alternatives in your strategic asset allocation. At this chart demonstrate here, the addition of alternatives to a stock bond portfolio significantly improves portfolio efficiency or the return per unit risk because you do have alpha in these asset classes versus the traditional stocks and bonds. The question is, how do you put them into the portfolio thoughtfully without upset your portfolio target risk? Kenny, could you please talk about how clients size an allocation to alternatives in general, and then in particular, what pieces?
Yeah, absolutely. Happily. Allocating to alternative investments from a quantitative standpoint can be challenging, right? Eva, you must have run into this through time. Like the data is just not there to the extent that it is in the liquid market. So it becomes, this kind of typical blend of a little bit of art, a little bit of science to make sure that you're managing risk. Ultimately, everything we do from an asset allocation standpoint is done to balance the risk return trade-off for varying clients with varying risk profiles. Alternatives feeds into that model. You do have to make common sense adjustments to some of the data. For instance, standard deviation on private equity, mathematically, standard deviation in private equity doesn't work. So you have to adjust that. And we do that. Thinking about it, when you're allocating to alternatives, you have the decision, or to private investments specifically, you have the decision of where that asset class, something like real estate in general, fits within a portfolio. And then you have the decision of how much public and how much private to fit into your portfolio. And there's an element of kind of strategic asset allocation. We do generally view private asset classes as having a risk premium associated with them that generates outperformance through time. You also have things like liquidity preferences and needs. You also have things like the ability to manage your portfolio. If you have the preference to be a very tactical kind of allocator, privates can be a little bit tougher because they increase the opportunity set, but they also increase how much capital is locked up through time. So you can't quite be as tactical. So Eva, I don't, I would love to have like one thing for you, but it depends on clients. It depends on the client situation. But on average, I would say over the past 5 to 10 years, we have seen allocations to clients or to privates within client portfolios increasing substantially. We think that's reflective of the growing opportunity set and how accessible it is becoming to investors.
Great. Brandon, same question, but perhaps you could add a comment about where you will source that, right? I've seen some practitioners carve out some allocation from the equity allocation or from the bond allocation or both. And how do you, I guess have a rule of thumb, or you use optimizer? What sorts of alternative asset class going into what type of portfolios?
Mm-hmm. Yeah, I think Kenny said it pretty well. There's not a perfect answer for kind of broad-based application. It really varies based on the client needs and the client goals in terms of strategic allocation strategy. The execution, I would say, also varies based on a few different things. So one, if it's a brand new account, new mandate that we've won, if it's an existing account, if we inherit a legacy portfolio and how that would be positioned versus our strategic asset allocation targets that we form, if there's outside funding sources or capital inflows, and then also the tax status of the client, and if there's the ability to do some tax loss harvesting as a way of a funding source. So just, I think ideally, like an E&F client would be like a good example in terms of ideal way to use funding sources. So, generally we would work hand in hand with the client very early on to determine the overall goals, risk tolerance, liquidity needs, appetite for alternatives. That would form the basis for our client-specific investment policy statement, or IPS. The IPS would indicate the desired long-term targets for alternatives, as well as kind of min and max ranges. And so if that client was using or had targets for both hedge funds and privates, the hedge fund book or the liquid alts book, we could get that allocation exposure put on in short order to really kind of get close to that desired allocation weighting. The privates book for an institutional account, that is designed to be a comprehensive long-term program. So for clients that have mature private portfolios, we would look to continue allocations via strategic annual pacing for private market asset classes. And we would aim for, kind of long-term private allocation percentages. And then we would balance those exposures to the asset classes based on our strategic asset allocation model. If it's a new program, a client that's interested in adding alternatives to the mix they haven't historically, we could aggressively pace to put the exposure on by using a combination of evergreen kind of open-end vehicles to immediately put exposure, and then kind of combine that by overlaying annual pacing with drawdown vehicles. And then in terms of the funding sources, it as I mentioned, it varies based on the client mandate, if it's alts only or if it's more holistic and we actually have discretion over public equities and fixed income. So if we assume that we have kind of that holistic discretionary mandate with public equities, fixed income, and alternatives, we would try to kind of match growth-oriented private markets allocations to be sourced from public equities, and then defensive or income-oriented privates from fixed income. So I discussed real assets previously. So as an example there, that could be equity or debt investments. And then kind of across the spectrum, it could be income oriented or higher risk total return. So you really need to know the characteristics and the return profiles for your private market allocations on a fund by fund or investment by investment basis, and then try to match that to the funding source. In terms of risk, I think that was the last thing that you asked. So whether it's portfolio volatility, VAR, max drawdown, probability of success, we use proprietary strategy analysis tools, and we model current and future portfolio risk and return characteristics. So this allows us to monitor risks, At any point in time, we can stress test, we can analyze various private market allocation scenarios or proposals, and then we can evaluate if we're able to add increased return or alpha while keeping the risk constant, or if any of the changes or adjustments we're making is actually going to change the portfolio risk profile to determine if it's in line with the client mandate and their risk tolerance.
Eva, I
Thank
think
you.
Brandon just said something really
Yeah.
important. Do you mind if I add one comment to reinforce it? Brandon just mentioned funding source within the portfolio. And, Brandon, you were talking about kind of the difference between private wealth and institutional. We agree in what we see, like private wealth is generally goals-based investment, right? People have cash coming in, they need to get it invested. They're kind of allocating to what's right at that point in time. Institutional world is where you're really talking about like funding sources. Most of these endowments already exist. They have some type of stock, bond, and whatever else is in their portfolio. You really need to think about where you're sourcing your alternative allocation from. We have a ton of clients that come in and say, I want to allocate to alternatives, get them in my portfolio. And, that conversation really leads to what our CIO would call misaligned portfolio. You really have to think about where you're sourcing the cash to allocate to alternatives. So as Brandon said, like it's a layup, private equity, it's a return premium to listed equity. You're going to fund that from public equity. Private debt, return premium to other spread-oriented private debt, relative layup that you're going to kind of fund that from your high yield or other spread-oriented fixed income. It gets wonkier with hedge funds and real assets because you really have to think about why that is in the portfolio. Hedge funds, you can have, something that's targeting 20% return, that should probably be funded from equity. If you manage hedge funds the way we do, where we're seeking diversification in kind of an uncorrelated but lower return stream, you're probably funding that from fixed income. I think it's incredibly important to think about to maintain your asset allocation while allocating to alternatives.
Well, I mean, that's a great point, right? Because when you're in the kind of theoretical lab, you're just thinking about risk and returns, but these things, even in terms of measurement, how do you measure the volatility of, say, private equity, right? If you rate what is being published, a lot of managers just basically marking on their models, right? Because there's no transactions for a couple of years. So the volatility is extremely low and the Sharpe ratio is through the roof, right? It's not true, but how do you actually manage to get back to somewhat closer to the truth? Kind of, you guys have your proprietary way of adjusting that to just trying to get back to somewhat of a truth, right? In terms of relative to other public equity. There are other issues in this, which is, both of you addressed the dry powder, which also implies that not all your allocation essentially are having that risk exposure at all times, right? You're only going to put that up when there are capital costs. So Jake, not to put you on the spot, but how do you account for these liquidity constraints and the target versus the actual allocation, i.e., you could have a big tracking error if you have lots of them sitting in the dry powder. And then also, how do you manage capital costs, which is the liquidity aspect of it? How do you manage that process so that you manage the total risk of the portfolio to be somewhat resemble, what you plan for in your allocation?
Yeah, absolutely. And actually address, I also want to sort of build on this idea of the lack of, not information is the wrong word, but sort of the regular pricing in privates versus sort of, public securities. What I have found is it puts extra onus on building really good relationships in this space. Because yes, you're going to do sort of your transformations, right, of the data to really understand how that impacts mathematically and sort of the quantitative impact on your portfolio. But I have found, and this is true as a practitioner in the VC space, and I imagine so as an allocator as well, and I've spoken with allocators, building real relationships so you can really understand what is going in the underlying portfolio so you can kind of make a art-based adjustment in how you're managing that risk. And Kenny mentioned earlier when he was talking about private credit, that transparency is really key. And you really only get good transparency when you build relationship with your managers. And I would put a premium on managers in the space that communicate well, that really sort of share what is going on in the underlying portfolio, that they are, current, that they aren't just relying on their marks to market, which are inherently lagging, inherently, as you mentioned, they can be stale. And so as you're allocating to and sort of managing your allocation to this space, you need more information. You need more qualitative information. You need more relationships so you can really see where you are and your risk and your allocation to this space. And then you can take, what that allocation is, make your art-based adjustment, I'll call it, and compare that to the rest of your portfolio, right? You get a lot of denominator effects in this space where public-based securities, their pricing moves more regularly. And so you can become under or over allocated to your alternatives and certainly to your VC, PE and the like, based on what's going on in your public portfolio much more readily. And so that's where really understanding what's in the underlying portfolio becomes, part of the skill of managing this well. And yes, there's more return potential. One of the costs of getting that return is I do think you have to be more active as an allocator. Spend the time to build the relationships, really understand the asset class, understand your managers and what's going into that portfolio.
Well, that's so smart. Premium on the managers sharing more information. I mean, I can definitely concur with that even back. But you touch on something that's really important, especially when we talk about private funds, because public funds have so much information out there. The whole industry, the whole armies of analysts are covering them. The private funds are harder to, in terms of getting at the performance, or rather the dispersion of which. So that's a good segue. Thank you for all your perspective. I think we can now kind of turn away from this. Manager selection is really, really important when you go from public to private. This chart is illustrating top quartile versus the bottom quartile performance. On the left-hand side, you see all these public funds, whether it's mutual funds, in equity, in bonds, in rates. The fact is they are all very closely clustered together. But this is based on 10 years of data, annualized. And say that you're not very lucky and you chose a bottom quartile fund, but you get 7% but the top quartile is like 8.7%. So the difference is less than 2%, right? So in other words, any idiosyncratic fund risk in the public space is not very likely to disrupt your total portfolio performance. That is just simply not true. In basically every single private asset class, you have these huge dispersion among managers. Take a look at VC. That means that you could, on the one hand, choose the top quartile, get 18% per year, or you could be very unlucky and get to a bottom quartile and actually lost 5% a year. And so these are huge, huge differences. And so this makes manager selection extremely important when you're talking about alternative investment. I don't think our industry is paying enough attention to that relative to just think about how many people are rating mutual funds. So Jake, I'm going to go back to you. Could you please walk us through what is a good process for manager selection in this type of private funds?
Yeah, for sure. I'll start by saying, if you're an allocator in this space, because of this chart, right? Because of the dispersion of returns, having in-house expertise on your team that's allocating is critical, and or working with really good consultants, right? Like Kenny, like Brandon, like others that really understand the space, because as you said, right, compared to public equities and things, the dispersion's not as great there. And so it's important to, have your allocation correct, but here it's meaningful. And so you need to work with people that know what they're doing, have the insight, expertise, experience, and process, right? So that's sort of high level. Make sure you've got the information, you've got the expertise on your side, either in-house or through a consultant or however you get it to allocate to the space well. So that's number one. Number two, building on this idea of relationships and the importance of good relationships that leads to transparency, flow of information, things like that. That means generally these diligence processes, when you're allocating to managers in the space, can take longer, right? I mean, I'll speak from my experience. A fast diligence time frame would be 3 to 4 months for a new allocator, but sometimes these are 6, 9, 12 months. We've even had people, allocators essentially build relationship over years and they get to really understand you and watch what you're doing and then allocate. And that's reflective of the long-term nature that a lot of the alternative asset classes have, right? And again, speaking to PE and VC, these are 10-year plus funds. There's liquidity constraints. These are, the long-term nature of it means you want to really put a lot in the front end of building the relationship and really understanding before you allocate. More specifically, there's all sorts of traits you're going to want to look for managers in the space, right? You want to understand in the VCPE space, to oversimplify, I consider sort of deal sourcing and deal picking, the ability to raise money, not just for their firm, but the ability to raise money for their portfolio companies. That's a key part, especially in the VC space, the ability to catalyze syndicates and help, fund good ideas to maturity. And then operational insights, whether it's strategic, operational business insights, people that are able to come in and really be hands-on and be helpful in the transformation of a company in the case of PE, or the building of a company in the case of VC. Those are some of the traits that you're going to want to sort of look to understand how the manager operates in that space.
Thank you. Brandon, somewhat similar question. Could you add your experience to this piece of manager selection, especially if you have full discretion over the solution? How do you maximize the probability that you end up with the top half of this chart, not the bottom?
Yeah, so I'll add a couple comments here. So first, even 100 basis points of excess return for, say, public equities, when you compound that over many, many years, the cumulative return effect is actually pretty substantial. So, I don't want to completely discount the fact that manager selection is important in daily liquid or public market equities and fixed income. I think, that piece of the chart here, obviously the asset allocation component can drastically change the return outcomes. So the top-down piece is quite important there. On the right-hand side, with the return dispersion, I mean, you've got to be in the game to win. So it is important to have a strategic plan for private markets allocations, to forget if it was Kenny that mentioned this, but vintage year diversification and pacing is very important. And obviously allocating to first or second quartile managers is even more critical, just given the wide return dispersion. And the other thing I would just add here is it's even more pronounced during challenging markets. So, you could see illiquidity premiums for something like private equity versus public equity well in excess of 1,000 basis points during market downturns. So you really want this as part of the mix in your portfolio construction. So, in terms of the manager selection component, it is important to find managers that have very repeatable processes, sourcing advantages, operational value add. You've got to be very detailed and deliberate in your evaluation of managers. You really need to understand who the key decision makers are, if they're highly aligned, what is truly driving returns in the strategy, and make sure that it's a consistent result of good investment selection and the strategy value add, and not something like financial gearing, and especially in today's environment where leverage is less accretive than it has been in the recent past. Additionally, it can be really challenging to get access to the best managers in certain asset classes. So venture capital is a prime example. So as an OCIO or a family office, being able to create those relationships with the GPs is very essential to getting access to, first and second quartile managers. And then from a discretionary account basis, I'd mentioned some of the top-down work and the pacing, but the team that I manage works very closely with our different client segments on the broad allocation targets for private equity, private credit, and real assets. And then we overlay strategic and tactical views within the bucket. So while we might want consistent pacing in something like private credit, the underlying mix of sub-strategies year to year could change in terms of what we want to emphasize or avoid. And then from the bottom up perspective and the manager due diligence and sourcing, we generally want to have visibility at, 9 to 12 months in advance in terms of deal flow and fund sourcing, and create a bespoke plan for each of our discretionary accounts within those asset class buckets to give a very, comprehensive allocation scheme for private equity, private credit, and real assets.
Great. That sounds a lot of work, but I guess, in order to get to the bottom of these asset classes, you really have to pay attention to all of those. But now, finally, I think there is one topic we haven't touched, which is in our business, no discussion will be complete without, discussing fees and vehicles. Traditionally, these private asset classes have been only available to large institutional investors. But in the last few years, access have been improved and vehicles are made available to more investors such as OCIO and retail high net worth investors. Kenny, could you talk about the fees in these alternative asset classes, both in institutional land and in retail, if you could?
Yeah, of course. Fees are high. We know that relative to traditional asset classes. Fees are very different by asset class. If you try to compare a private equity fund relative to a private credit, relative to a real asset, even like within those sub strategies, and then relative to hedge funds, they are all different. They're all different structures and they're totally different focus. So it's an asset class focus. But generally, you have some element of a management fee and a pref return, whether that's carried interest in the private space and then just a traditional kind of annual pref in the hedge fund space. I think it's really important within asset classes, and I'll give an example to look at specifics. So with private credit, for a long time, they kind of mocked a private equity fee structure. You were looking at it may not have been 2 and 20, it may have been 1.5 and 15 on committed capital, but you were looking at kind of this traditional committed capital fee structure that may or may not be appropriate. Private credit's moving toward open-ended fund structures. We know that getting capital into the private credit market and keeping it there is one of the biggest drivers of performance, because that's how you compound, and it can be relatively difficult to compound in a closed-end fund structure. Should you be charging fees on net invested capital rather than committed capital on open-ended funds? Things like that is really, really important. So again, asset class by asset class, fees are relatively high. Within private equity, we're still not seeing a ton of movement on fees. Within private equity, manager quality is important. The really good managers usually aren't negotiating fees. What they will do is give co-investment that helps you average down your fee exposure. You can access co-investments in a few different ways, whether it's a commingled fund or directly if you're large enough. Private credit, again, the big thing is things like net invested capital. How much pref do you give? What happens when you change from a closed end to an open end fee structure? In the real asset space, a very different fee structure on kind of core products relative to value add and opportunistic. Core is moving toward a net invested capital type of fee structure. It's, again, the basis points. You can generally negotiate on the pref these days, and you can get basis points down below 100. So, it's getting relatively cheap, where value add and opportunistic is still staying closer to the traditional other kind of private asset classes. And hedge funds, we have seen a turn in investor interest, but it has been a difficult period by way of investor interest for hedge funds. These usually are getting negotiated and coming down a bit there. That's in the institutional world. It totally gets tossed in its head in the retail space. As you transition from traditional institutional private wealth, you get a whole ton of, a ton of different fund structures and new fee structures alongside that. So again, kind of going asset class by asset class, hedge funds are very different than privates on average. Core real estate is very different from value add and opportunistic real estate on average. But in things like non-traded REITs, non-traded BDCs, interval funds, some of the other structures that we're seeing become accessible to private wealth, you're usually seeing like a 1% on invested capital and 10% pref on these kind of open-ended structures. And then for the ultra high net worth segment, the family office segment, if you're trying to allocate $500,000, $1 million, $2 million to high quality funds, you're usually paying some type of feeder fee on top of whatever that fund fee is. If you're going directly into one of the more traditional closed end funds, make sure you're monitoring what the administrative and the feeder fees are, because they can be a lot. And you should be kind of benchmarking what your structure is in addition to what the investment manager is doing.
Great. Thank you for that comprehensive coverage on fees. Brandon, do you want to compare and contrast in terms of access? What type of vehicles the institutional versus retail investor will be, kind of set up to access these alternatives?
Yeah. So I think Kenny touched on a lot of good points already. I mean, institutional investors have always had good access for alternatives. I think historically it's been the retail investor that's lacked options. That's changed over the last several years. I think GPs have begun to better understand the power of wealth management and retail client platforms in terms of scale and deployment, especially after 2022, when a lot of institutional clients with legacy private programs were kind of over their skis in terms of their illiquid allocations. GPs needed to find new ways to raise capital for their new vintages. And so they were more open to working with wealth management platforms. And they've also evolved in terms of vehicle creation. We've seen a lot of evergreen vehicles that we call it the democratization of alternatives. They've broadened the access. They've come down market in terms of investor eligibility requirements, as well as lowering their investment minimums. And they've done that through the evergreen structures that Kenny mentioned. So non-traded REITs, interval funds, perpetual BDCs, and now we're seeing more evergreen private equity vehicles that are coming to market. They were a little late to the game, with the exception of a couple players in the space, but now we're starting to see a lot more of those vehicles in the market. And so we think these are good vehicles for retail investors. I mean, they get you the exposure quickly. Clients don't have to deal with annual commitments or re-upping, which is especially hard for smaller account sizes to do that in a diversified manner. The fees can be standard or fairly competitive across vehicles. There is some level of liquidity versus locking up for 8 to 10 years. And for taxable clients, they can be more investor friendly in terms of 1099s versus K1s. So we think it makes sense for retail clients. For institutional investors, there are use cases for using the evergreen funds. You can get the exposure quickly, or you can put on a good allocation, like to a perpetual BDC over the last 2 years, and get mid-teens returns and 10 to 11% yields versus doing a drawdown direct lending fund that takes 2 to 4 years to kind of call capital down and deploy. So there are use cases, but generally we think institutional accounts, which are, typically bigger and have more capital to put to work in private markets, should combine that with pacing of the drawdown funds and the use of co-investments that Kenny had mentioned, kind of blending down the fees. It also co-investments gives you the ability to access or increase exposure to top company ideas that are in your portfolio already, as well as industries that are hard to kind of isolate. If you have a thematic opportunity in an industry and you don't have a dedicated primary fund for it, you can get the exposure on through a co-investment. So we think that makes a ton of sense for institutional accounts.
Great. Thank you. We can go on for another hour, but I think we're out of time. That includes our discussion. Our sincere thanks to all our panelists for sharing their experience and expertise. I've personally learned a lot this morning, and thanks to Chestnut for this opportunity to moderate this event. With that, I'll turn it back to Michelle for closing.
Great. Thank you very much to all the panelists again, and thank you to everyone who listened and took the time to join us today. If you want to learn more about the Institute or get a copy of any of our public research articles on the solutions marketplace, or review any of our prior webinars, you can certainly access them on our website, and we'll be sending you a replay of this webinar. With that, have a great day.
Chestnut Advisory Group is a boutique, practitioner-led management consulting firm dedicated to asset managers and investment solutions providers. In addition to the Chestnut Solutions Institute, our advisory practice areas include distribution strategy, M&A support, go-to-market, and implementation and coaching services. This podcast is owned and produced by the Chestnut Solutions Institute. If you like this content and would like to access more insights, webinars, and podcasts, please check out our website, chestnutadvisory.com.